So what is the biggest consequence, one of the biggest consequences of cash flow management issues? Hi, I'm Renette Legace. I'm with Net Bookkeeping. I'm here today to talk to you about solutions to help your business manage cash flow issues. So the biggest concern that happens with small businesses, they're technically a proprietor. Whatever they earn in their business is claimed on their taxes as income minus all the expenses of their business. But what happens at year end, they get a huge tax bill because they are taxed upon all that income, net income, I should say, income minus expenses, so net income at year end. And they get a huge tax bill per se. Now, let's be clear. If you are not paying taxes, you are not making money in business. There are ways to make money without having to pay a lot of tax on them, but with business in particular, that's considered income. So your net income is your income that you claim on your taxes. So if you do not have money set aside for that bill at the end of the year, it can be a hefty bill. And if you're not prepared to deal with that, how are you going to deal with it? Yes, many business owners will actually start a monthly payment plan with the government and say, okay, I know I owe you $30,000. Let's just pay $800 a month and I'll pay it on the 15th of each month and I'll send it to you. That's awesome. So let's just say by the end of the year, they manage to pay the majority of it off. And guess what? They get another $30,000 bill at the end of that year, plus whatever is left owing from the year prior. So now you've got maybe $40,000 owing. And it just snowballs. It keeps going and going. And the government, yes, it's great that you're making payments, and they're happy as long as you're making payments and you are talking to them about your bill. Yes, you need to pay your taxes, whether it's only $10,000, $2,000, or $30,000. Now, if your business is claiming a loss every year, well, okay, fine. You're not having to pay a lot of tax. You still have to pay CPP because that's separate and over and above, but your income tax will be a lot less. Okay, so you're claiming a loss every year. Great. You're not having to pay much in tax. Then what? Can your business go get a loan, a business loan? Can your business leverage itself to, say, buy some property to grow? Probably not. If you cannot show the banks that you are making money in your business and actually growing, you're not going to get a loan for any business improvements or business expansions. You have to show growth. And every time you show growth, you're getting taxed and you're having to pay a big bill at the end of the year. So what do you have in place to help you deal with that? Do you have a plan? Do you have an accountant? A bookkeeper is helpful, but an accountant will kind of give you a good idea of what to set aside. So what, as myself, as a bookkeeper and other fellow bookkeepers who really are looking out for their clients, they ask them, set that money aside every month in a bank account. So when you first start this right away. Do not cut yourself short every month. You need to have that money set aside so that when that bill comes, you have that money at the end of the year to pay it, whether it's your GST, payroll remittance, or your taxes. Right now, I want to focus on taxes. How are you going to pay your taxes? You're just going to make more money? Well, that's great. But you're going to still be able to, you're still going to have to pay money on that income. Whether it's corporate or personal, there's going to be taxes. So make sure you have something set aside. Now, what are you going to do this? How are you going to set this aside? A very common practice that a lot of businesses do is have a separate account that's specific just for taxes. for that business owner. So there's basically two accounts. You're going to have your business account, and then you're going to have a separate account just for liabilities. Maybe taxes, your GST, your payroll remittance, but that's stuff that's not for you to use. You set that money aside and do not use it. Now, as a business owner, if you only received $10,000 in income that month and you set aside $2,000 and just use the $8,000 that you did receive to pay for everything else you're running your business, buy those extra equipment or whatever it is that you need for your business to be successful, use only the $8,000. If you only receive a certain amount of money, that's all you're going to use, generally. So if you use a little bit more, because guaranteed you are going to run into a problem. The government does not take kindly to those who do not pay their bills or remit things on time. So we need to make sure you limit your liability. One of those ways, just one of these techniques, is to have that separate bank account that's specific for taxes, for your GST. So every time you receive 5% on whatever sale you received, you put that aside. And when you file that GST, quarterly or monthly, or maybe it's annually, for a lot of small businesses, it's annually, because you're not making enough money yet to file quarterly. What happens is any GST that you've paid out, you claim against it. The difference, your business can now keep. But you have the money set aside to pay those bills specific to the government. Keep that government account. That is probably one of the more crucial aspects of setting money aside so you are not spending it. Now let's go back to taxes. How much should you set aside every time you're paid? Now you're setting aside in that account for the time being, and once your taxes are filed, whatever you owe, yes, you pay, but if you don't have to pay as much, that's yours. That is for your company. That is for you. That is why we do this. One, we make sure we have enough money to pay the bill. And two, once everything's filed, you know exactly what you have left to work with. And that is what you can move back into your business or use for your personal use. That's really crucial. So how much should you set aside? Well, if you look at a payroll program, there's usually a percentage people have to pay on taxes and CPP and EI. And that can be anywhere from 14 to 26% right off the bat, depending on how much you are making or not making. If you can set aside 20% of everything that comes in, you'll have a good chunk of everything you need to pay when it's time to pay it. So 20%, yeah, that sounds hefty. And you might, for some people, it should be higher. But you won't know that until all of that is filed at year end. Your GST, your PST, maybe if you have it, your personal tax, and payroll remittances. Now with payroll remittances, guaranteed you're going to have to remit that every month. Do not use the money that you've withheld from your employees for stuff that's going on in your business. Again, that is trust money. They can come in and seize your account, your personal accounts. They can be really difficult to work with if you do not remit. So that's today's tip. Next week, we'll be focusing on another aspect of how to keep cash flow and cash management working for you in the best way it can for your business. Again, if you have any comments, questions, or want to get in on the tips and tricks that I'm going to send at the end of this month, just put it down below and I will get back to you. I look forward to hearing from you. Have a good one.